Okay, so welcome everyone to week 3. This week we're going to look at one of the key business drivers that's totally under our control, and that's one of the fastest and easiest ways to save some money, and it's your overheads. Always like to call it quick win cash strategies. So almost every time we analyse the overheads of business, there are loads of opportunities for quick cash. We look at the strategies to improve return on investment, and frequently we find large sums of missing cash that are there for the taking. So let's have a look at overhead optimization. Just want to have a quick summarise of the 12-week programme. So weeks 1 and 2, we looked at the key business growth drivers, small incremental gains, and how they impacted and delivered an outstanding growth. Week 3 to 9, we're going to delve into much more detail, give you practical, real-world, low and no-cost things you can do to improve your business through the growth drivers. So we'll cover quick win cash, which is this week. So those are your instant savings and opportunities. Next week is cash flow. That's going to be run by Charlotte, and that's the fastest way to improve your bank balance and stress levels. We'll then explore strategies to improve gross margins before looking to plug the leaky bucket, improve customer retention. We'll then work to upsell, cross-sell to better serve customer needs and bring more sell more to existing customers. We continue the theme in week 8 by looking at strategies to increase the number of transactions and transaction value. We then explore new customer acquisition, and you'll be stunned to know how much growth and potential exists out there. Now we know how to grow a business, to what end. So we need to know exactly by how much and by when we need to grow the number to give us the lifestyle we desire. Armed with a target in terms of exit valuation and timescale, we need to know what goes into preparing for exit. There's a lot more than most people appreciate. Finally, now we have the course structure in place with a detailed plan, a detailed 3-way forecast covering profit and loss, cash flow, and the balance sheet. So just another recap of what we've talked through before. So whatever your goals, you want to be clear on what you're trying to achieve and by when, because a goal without a timescale is simply a wish. We need to be mindful that success is not guaranteed and the odds are stacked against us. And do remember that without a robust plan, chances of success are all but zero. So there's a 1 in 2,222 chance. Now, as accountants, we do seem to receive a lot of information quite late in the year, and obviously we're looking at the lag indicators. Now, we don't want to do that. It's not information that's relevant anymore. We want to start looking at what's happened now, what's going to affect the future based on real time, etc. So we're trying to look at the lead indicators. So that's much more up-to-date information that will give you a better return for your money, hopefully. Again, the British cycling team. So we went from 1 gold medal in 6 to 7 year history to the Beijing Olympics, where we won 7 out of 10 golds, and repeated that success 4 years later. So that was only achieved by breaking everything down into those 1% incremental gains that we constantly talk about here. Remember, businesses have at least 7 KPIs. 6 business growth drivers, so your margins, overheads, new customer acquisition, customer retention, your transaction value, and purchase frequency, and finally, cash flow. Now, we're going to look again at Alex's and his dilemma. So, as we all remember, Alex's revenue is quite flat. He's been able to put his cost of sales down slightly, put his gross margin up by 1%, his gross profit up by 1%. And he's got that £19,000 extra profit, but he hasn't thought about the other areas in his business. So as we found out before, there's that big overdraft in the business. So Christmas, etc., is on hold at the moment. New car, new house, holidays, everything is going to be a little bit more tight for Alex. And it's a very difficult situation to go back to the family and say, hold on guys, this year, that's not going to happen. So again, we need to look at what we can do for him, and looking at the other areas to increase that cash balance. So we looked at scenario 1, busting a gut, and as everyone saw, we increased the business by 50%, loads more work for Alex, £500,000 extra. But what did it get for him? He got an extra overdraft of £24,693. So for Alex, that wasn't the way to go. We then looked at exploring what about if he also outsourced his credit control, getting his debtors chased for money that he already had done work for and received. And we found that this impacted the business massively, giving an extra £106,000 in the bank. Alex had to do a lot more work, also outsourced it and brought that in. So we then thought, what about just bringing in a credit controller, pay a little bit of money just to chase the money that was already there. And as we saw, by bringing that in, we were able to change things into a positive as well, only by a little bit less, but it just meant the business wasn't growing by 50%. There wasn't additional stress. So just going to recap on the 7 business growth drivers again. So for you, so obviously there's cash flow, money in, money out. Your margins, trying to grow those based on your sales. Quick win cash, which is today. So overheads, we're looking at bringing in the easiest way to save money by not spending as much. Your acquisition, your retention, transaction values need to go up, and frequency also needs to go up. Now, there was some homework from last week, so I just want to know, did anybody have anything? Does anyone struggle with any of the information? Anyone have any queries here that they can explain, or does anyone want to see the sort of growth model from me? We will go through it again later, but we asked you to sort of put together your growth objectives, see if you can work out a scenario, and then did anybody put together their overheads and see what happened year on year? No? It's absolutely fine. We'll have a look at what you can do with some visuals in here today, okay? So there's no problem there. Okay. So our models will make it look easy, but running a business is tough, okay? So the big 5-year goal is to sell a business. Now, there's an elephant in the room. And the problem with this is you've got to work out how you're going to break that down. How do you eat that elephant? And the problem is it's huge. You can't do it in one go. So what's the idea? Now, the answer is we look at eating it one bite at a time. But we look at how. So we'll break it down for you into the most manageable and possible scenario. So 5-year goal. So first of all, let's break that down into years and then quarters. So already we've broken down the tasks in smaller areas that should make it more manageable for you. Those on VAT, doing VAT, you know, you're already doing it quarterly. Let's break it down into those sections first. Then we can look at breaking it down further into those years, quarters, and months. Make it even smaller chunks for you. So you can set out your staff with monthly tasks that will then help you quarterly to then get your goal for the year. And then further than that, we can look at a 90-day scenario, looking at weekly chunks. So you can set yourself tasks that are much easier weekly, then set a bit harder tasks for monthly, then much more difficult tasks for quarterly, and then eventually we should have our 5-year goal sorted. Now, I'm just going to go through Alex's software again. So this is the performance. This is what came out of his system and out of his software. We've run through a few of these figures before. But what we're going to do is we're going to flip the colors and show anything in red has gone down and anything green has gone up. So have a quick look at what happens to his business. So his debtor days went down, went up, which is bad for him. It means he's taken 3 days longer a year to bring in the money to his business, which means he has less cash in the bank. Another bad one, he's decided to pay his creditors earlier, which means also he's spending more cash. So he's bringing less in and he's spending more out, which isn't good for him. His margins did go up with the smaller cost of sales, only by 1%, but that's still something for Alex. We've reduced his overhead cost from 283 by 3.7%, so now it's 270.5k. So again, that's green, that's brilliant, that's going down. The acquisition numbers, so these are going down, so he's lost clients, so we need to find out why. Retention also gone down, so we're not holding the old clients as much as we were before, and we're also losing new clients. Transaction value again going down, so the business is taking a real hit here. Everything's not working. And finally, frequency has gone up. So the number of transactions has gone up as the number of customers have gone down. So if it had kept everything going up, this business would have taken a massive extra chunk of cash and turnover. So we're going to look to challenge you on these areas of concern, okay? Just to point out, the main area there is the 270k extra. Well, he saved for 3.7%, which for him was 13k. That's a brilliant saving just by looking at what he can do to reduce his costs. So can anyone here, can you distinguish the difference between an overhead cost and what it means? So they're not directly impacted by revenue. We're just going to have a quick look at what the different areas are. So here we've got our total revenue. So this is all the sales coming into the business. What we're going to do next is we're going to start taking off our variable costs. So our variable costs are made up of our cost of sales, direct costs, but there can be some direct wages in here. There can be some materials, purchases of stock are in here. So all of this relates to so variable cost is something that is basically relates to the revenue. So you're only spending that money to make a revenue. Once we've got that variable cost in there, we've got our gross profit. So our gross profit tells us how well we're performing. As you can see in that image, gross profit is quite high, it's above halfway, but that's only with decent bookkeeping. That's only if things are in the right place where we have the right gross profit. There could be wages in the wrong area, which could be pushing that up, and it should actually be pushing it down. So some direct wages could be accidentally analysed into fixed costs. Your fixed costs should be made up of your overheads and all your other expenses. So there will be wages in here, but not directly related to that revenue. And those are not attributable to the revenue. And after we've worked all of that out, a little bit chunk at the bottom is what we call our net profit. Does that all make sense to everyone? Okay. The first thing to do is to make sure your bookkeeping is correct. So again, we looked at fixed costs versus variable costs. So without that correct analysis, we really are going to find it difficult to produce a set of accounts that gives us the right information. It goes without saying that unless you get control of your bookkeeping, those issues are going to make it difficult for investors. We're here to help you. So is your bookkeeping of a high standard? Do you know whether things are in the right place? Do you do it yourself? Do you have a bookkeeper? Do you have just one of the office staff doing it for you? If you don't, you need a little bit of help. Obviously, we're here to help you. So if you need to give us a call or an email, just do so. Okay. Now I'm going to run through some visuals of what we've put together for clients when they give us their information and how it looks for you. So there's going to be a lot of visuals here. There's also going to be some descriptions. So at the moment, I'm going to run through these bits and pieces. So we start putting through little descriptive areas, telling you how your overheads have changed as a percentage of revenue. And for Alex, it was down 1% versus the previous year. We can also look at how it decreased compared to the previous 3 months. So for him, it's down 35.3%. So again, for you, this will all be against your figures. Then there's visuals. So we start doing, so on the left-hand side here, we can see this is on a quarterly basis versus the last year. So the most recent one to May, that'll be May versus what happened in May the year before. And then we've got 20.3 at the top there. So that's May again versus last year. Then 61.1 is the quarter versus its quarter last year. And then we've got year on year. So again, that's the 270.5. That was the reduction to overheads overall. And then there's other visuals there which tell you this year versus last year. And as we can see, we've saved in all areas at the moment. It's gone down. We can also put together a top 10 overheads report. So this pulls in from your information, and please ignore the names and numbers there, they are just fictitious information. But what you can see is it will detail to you this year, last year, the variance. It will also look at the percentage difference on revenue. So there's areas there that you can just look at the figures. We'll pull them off. Anything that sort of stands out, we'll highlight them for you. We'll come to you and we'll say, look, this is a problem area, or this is an area you're doing well in. If you've got problems with your top 10 overhead costs, then obviously those are the areas that are going to affect your business the most. Those are the areas we need to focus on. And further than that, we can do graphical information. So as you can see here, we've got the last 3 years there. So the green line is the current year, and it also does a projection going forward. So at the minute he's got 113K, projects to 257, and that is currently lower. So this is overheads. This is lower than the previous year and the year before that, which is great for Alex. We can also look at this section. So in here, we can look at the gross margin against revenue again. So we'll give ticks and crosses where things have gone well, things have gone badly. Things that stay the same are the yellow movement line, sorry. And then we can also, so this one just pulls together, it just says what, so this basically says, here's your final, so 270.5 turns into 271 with rounding, and then it works out what your revenue, and it gives you green if it's good, red if it's bad. So at the minute, he's made a saving. It's 4% overall of overheads, which turns out to be 1% of his revenue, and that's given him an extra 10K of profit into his company. Now, do those visuals look appealing to anyone? Is anything quite difficult on that? Will make sense again?
Yeah, that makes sense.
And further, so again, we'll give it a bit more detail. So you'll see here that just gives a description of what's happened on that 270. So this is all against overheads. So we can do revenue, we can do other costs, we can do your variable costs. So this is just purely for overheads at the moment. This is what you can start getting. And again, we're looking at that small image again. So he's made 10K extra into the business. And then we can start doing overhead trends. So now we can see there's other visuals that come out of this. So we've got the flags. We can show last year versus this year, quarter versus quarter. We can also look at month versus month. And as you can see there, that's quite good, that trend. It kind of stays steady. There's a little bump in one area just here. Sorry, I didn't open that slide. So we've got a bit of a bump down the bottom there. So by using this visual, you would never have seen that information. You may have known you spent a bit more money in 1 month, but this visual stands out for you. And for you, it could be that the bookkeeping is in bad order. It could be that cost was an insurance policy that you paid in full, that you should have paid off monthly. We should be accruing it and spreading it out throughout the year so you can track things a bit better, bring that trend down. We can see the green lines there are quite steady, so it brings it back in line because that is just the average. However, those things will stand out. And for you, just to looking back at that month, we can then pinpoint that issue and see what can be done to change the bookkeeping, to change your accounts and make it look better. And at the same time, that means that we can look at that overhead and see if we can save some money on it for next year. And further than that, we've got the flags here. So we can flag up that quarter was down. We can also flag up this quarter was down. Was not down, sorry, but it was up. So we were overspending in that quarter. So let's look at some more visuals. We can then do the top 10 overheads on a graphical basis. So earlier on we had the breakdown of the figures this year versus last year, just telling you the figures, whereas now you can actually see a visual impact. So at the moment we can look at, we've got 10 costs there. We're quite, first one, pretty much similar, but we can see this year versus last year where we're actually saving the money. So at the moment, a lot of those aren't pulling out, but those overheads are changing. And then we can change that further into, again, looking at the monthly basis. So we look at the month of May versus the month of May last year and how it did for the previous month before that, and also for the month itself, the year before that. We then do a quarterly again. So again, it's the quarter that's just happened against the 3 months before it, and then the same quarter for the year before. And the yearly cost against the year before, and then that gives you those figures. So does that all make sense? That more visual feel, I think, is what people need sometimes. It is a little bit more difficult to just give you a description. It doesn't make sense to some people. So we're breaking it down this way. You can see the issues a bit better. And as you
Yeah.
can see here, there's quite a lot of red. Nothing's moving in the right direction at the moment. Now, recurring payments. So we looked at pulling out the graphs and seeing where things had sort of fluctuated, but we've got recurring payments that change every year. So we pay for insurances and utility bills, and people decide that they're just going to stay on the same with the same provider, with the same insurance company, and they don't think about how they can be making a saving. And as we all know, it seems like insurance companies and utility brokers do not want to keep you as a customer. So in our training sessions here, we're talking about customer attrition and keeping people in. These companies seem to want to kick you out and give you the best deal if you move elsewhere, which doesn't make sense. With your recurring payments, so if you have a board of directors, by them making a decision on whether or not you set a cap on what you spend each year, some brokers or some insurance companies will think, right, the only way I'm going to get this business next year is by bringing our costs down. So sometimes by having a board on top, having a set level, you can call that supplier up and say, unless you can bring it down underneath this level and be more competitive, unfortunately, we've got to go elsewhere. So again, renegotiate. It's all about renegotiating. By renegotiating, we're going to save money. The quickest way is to get on the phone and say, look, can you do anything better for me? We moved office recently, and we could have stayed with the same provider for our energy, but we moved over, and as soon as we moved, they were able to find us a much better contract. We signed up with them, and we saved ourselves a heap of money. Got our direct debits down, and for us, that means more cash in the business, which is what we all want. So yeah, you can renegotiate on all types of things. Obviously, there's certain suppliers you can look at, maybe asking them for discounts for bulk buying. That may be a thing for you if you're into buying stock. We can look at dual source, so don't just buy from one supplier. So you can save a little bit of money by buying from two different people. So get the benefit of buying 75% of your stock from one supplier, buy the other stock from 25%. And the good thing you've got there is that if you're buying from two different places, if something happens to one of them, you can start utilizing the other one a bit more. You can avoid your delivery delays and kind of avoid losing customers by not being able to provide the service that they need by utilizing the stock services that you need. So again, not all overheads are the same. So some do generate a return on investment. So what about positive ROI? So things like marketing, advertising, they bring money into the business. Okay, they're marked under your overheads at the moment, but you spend money for the purpose of making money. Every business spends money on marketing and advertising. So we're going to have a look at in a second about how those areas have impacted Alex. So we're going to go back to the top 10 overheads again. So as we saw here, there's a marketing cost here. So we can look at this year versus last year. So we can see our marketing cost has gone up this year versus last year. And advertising, again, we spent more money on advertising than last year. But what does this mean? Alex has lost 19 customers, sorry. So why is he spending more but losing more customers? Is he spending the right money at the right time for the right thing? He's also not retaining customers. What's happened? What's his marketing strategy? What's happened? Why is he spending that money to overall bring the business less money? We look at and give you this visual and basically give a report to help you work out whether you should spend less next year because you know that maybe the acquisition or retention rate is going to go down. Obviously COVID's happened. We know that retention might be quite difficult. Let's cut your marketing costs for a year and then change the strategy going forward. We could also look at overheads on another different basis. So obviously we've got marketing, advertising and promotion there again, and we can start flagging it up. So we can see a couple of red flags in the marketing and advertising, and that's all because they've gone down. And let's just put that cost together. So we've got a marketing cost 15.9K. Advertising was 11.2, and our promotion was 7.4. Overall, it was £34,500 that Alex had spent which was 12.7% of his revenue. And that's a large cost for somebody who's not making additional money into his business. He saved money by cutting his overheads elsewhere. So utilities is a commodity, so surely there's no real scope for savings. Obviously, as I said earlier, you would be wrong. So consider switching. So as I said earlier, we've switched. There's so many options out there to go and do that. There's easy money to be saved. Okay, it could be a couple £100 here and there. But, you know, for a larger business, there'll be more and more savings. A couple £100 in certain times will help certain businesses massively. And also, just for you, it's just why overpay? Why not go and see what you can get elsewhere? Just spend that little bit of time and see what's better for you. Again, so look, heat and light here. So for Alex, he's actually done quite well. So he's actually got a positive, and he's brought his heat and light cost down. So we've got a green flag, the cost is down, and as a percentage of revenue, that's also gone down. So that's great for him. If you can do that same for your business, that's great. But obviously, there'll be certain businesses here that'll be red, the flag will be red, and the cost will have gone up, and we can pick that out for you. And by doing that, you just need to get on the phone and just say, look, when my contract ends, if it's already ended, let's just change it now. We'll have a look at getting another broker. Now, there's a bit more here about the utilities. So we can do a graphical basis based on that customer that you're paying to. That supplier you're paying to, sorry. So as we can see here, Alex has been with that utility supplier for 75 months. As we know, it seems to be after 12 years, they put your prices up. And why has he stayed with them for 75 years? Is that he hasn't thought about it, hasn't decided to change, he's just taking it a bit easy, he's left somebody else to it that hasn't looked at it. There's lots of information here that he hasn't looked at, and he hasn't thought about how to change it. Yes, his heat and light cost has gone down, but that could be due to other areas. And this graphical basis does show you that his costs fluctuate quite massively. And as you can see, just before the green line, again, we've got another spike, which is around the same time as your other overheads spiking earlier. It's all over the place. There's nothing standard. Obviously, we know utilities, there are seasonal bits of the year. So it's whether or not that graph works and actually runs in line with that. You can see that there are actually bits and pieces here where it's gone down to zero. So why is there no cost in there? Is it that somebody's done the bookkeeping wrong again? Should this bigger line earlier on here, should this have been brought down and brought forward? Has somebody put the wrong date in? So these are all things that it's not just looking at your overheads, it's also looking at, are your accounts correct? Let's go forward. And we've got R&D tax credits. So if you are a business that specializes in creating something scientific, there are R&D tax credits from HMRC. HMRC are very hot on this these days, and it is getting more and more difficult to get those R&D tax credits. But if you've created something, say on a football pitch, you see now that all the banners around the pitch have gone electronic. They're no longer the card. That was all created by somebody, and they would have claimed an R&D tax credit based on them creating something that later on could be used by everybody. And businesses don't go and look at whether they've created something that can work for them. Now, you may have something in your business. You may be let's just say we've got Tim on here as a web designer. He may create something that works for a website for everybody. He could create something that nobody's thought about, that would work for every single website in the world. Just a little bit, maybe somebody created the pay button for buying something on a website. There would have been time spent on that in the business that could have gone to HMRC and said, look, I've created something, I've spent this cost on wages, I've spent this cost on developing it. Can I get an extra bit of money into my business? And the answer would have been yes at that time. Okay, there's less and less that's being created that's new now, but there are things out there. So without thinking about it and without having a look, you will never know. So if you do need help with that, if you've created something, just give us a shout. We'll see whether we can put you in touch with, or Charlotte will run through the R&D stuff. We've got brilliant software that will help us. There are other people that do R&D if we can't help. It's always good sometimes to have a few people have a look at it, because it's a no-win, no-fee basis. If you can't get the tax credit, you're not charged anything by people. However, if we can win it for you, there is a small charge, and it's win-win for everybody. But yeah, if you've thought about creating something scientific, just let us know and we'll see if we can help you. We're going to look at budgeting and spending controls. So if you don't forecast every year and establish a plan, how do you know what you can afford to spend? So by budgeting, okay, you don't have to hit that budget, but if we set a budget of £100 a month on utilities and we spend 50, then that's great. If we know we're spending more than that, then we spent more than we wanted to, and that's not a good thing. But by having a budget, we can then ring somebody up and we can say, right, this is my goal. This is what I want to spend. Your business may be larger in that you can't reach that, but by having that call with somebody, having that check, you can also change your budget based on your business type. Oh, okay, so actually, finally, so we've got IT and impact of staff downtime. So investment into IT. So again, everybody needs to start doing things more securely now. Our IT guys are brilliant in that they send through information to us to keep us secure. There's all things about password to avoid people getting hacked and avoiding that downtime. So without a decent investment into IT, you could be hacked, lose all your clients. You could also be sued. There's a lot of areas there that can change your business just by looking at spending a little bit of money, just getting the right person in to secure your business. And with everything going digital these days, it's a major factor, but it's not a major cost. But again, call around, speak to a few people, see what they can do for you. And finally, we're going to build your forecast. So we're going to build your forecast. So as we know, we said that Alex was going down by 4%. So we can use the growth model to give us our forecast for the future. So I'm going to go into a bit more of that now. Again, just want a quick recap of this area. So the visualization, we went down by 12% of revenue. Overheads were down by 18.9%. And obviously we looked at those additional savings in marketing. A saving of 4% next year, what could that be? So at the minute, Alex's business, we're going to do nothing. We're going to leave it as it is. We've got our 53k overdraft. We haven't changed our overheads. We haven't changed our revenue. We haven't changed debtor days. What has it done? It's done nothing. The business hasn't moved, okay? We're going to look at changing this figure to 4% of revenue. We're going to say what happens if 4% of revenue is reduced, or 4% of revenue is our reduction in overheads. Okay, so the next graph is going to detail what happens. So here's our 4%. As we're going to see, we've been able to save £40,000 in overheads. And this is based on revenue. So we've got $1 million at 4%. We haven't changed our debtor days, but as you can see, they're a very small line. The creditor days have slightly changed, and that is because we have less to pay out based on that revenue. And overall, that £40,000 saving has turned into 37 once you take off the small amount that changes. So Alex's business has been able to move that bank balance up slightly, giving him a little bit extra, but a little bit less stress, let's say, and he's pushing in the right direction. So maybe in year 2, we're going to start seeing a positive down the bottom. Now this £37,000 is going to be key for him. Okay, he can't take it out, but he's paying off that overdraft. And I just want to recap the growth scenario here. So I'm going to run through a little bits and pieces of what we just talked about before. So as we saw last week, Alex's business, his net profit was going down year on year. He was losing customers, wasn't changing his overheads. He was losing, his customer attrition was going down, his transaction values were going down, but his transaction numbers were going up. So overall, he lost 26.2k. We're going to look at changing these two figures down the bottom. So as we saw last week, so the growth model, if we plug in a figure just for overheads, and let's bring it down to minus 4% again, let's have a look at what that does for his growth scenario. So we can see now the overheads have gone down. They're going down year on year, 4%. The net profit for that year was 79.9. And as we can see in year 1 just after, okay, because we lost a few customers, it went down slightly. But as you can see going forward, it starts going up to 81, 87, 95, and eventually we get to 105. Now that's brilliant for Alex. What he's done is he's got on the phone to somebody, he's changed his utility contract, he's changed his costs, he's cut out things that he didn't need to, he's reduced his marketing because it's obviously not working, and he's got himself to a profit stage. So what would you have done with that extra increase? So now we've not just got 26 minus, we've got 23.7k increase. So for Alex, that's nearly 60k extra in the business. And it's not, as we saw just a minute ago, it's not going to put his bank balance into positive straight away. In year 2, 3, it will, and then up to year 5, it will. He's brought an extra cumulative 155k into the business over that 5-year period. So for him, that should pay off the overdraft and then start being able to think about dividends. But we can change that. So we can say, okay, let's do 6% change in overheads. And again, we've got this model. If you want to have a look at it, we can start, and you can start plugging in to see how much it would change. So I can send that to you afterwards if you'd like it. And what's the time? 8:38. So I've got Cliff on the call. I don't know if Cliff wants to share. He's got some really interesting ideas of how you can affect your bottom line just by looking at some of your overheads. So Cliff, do you want to share your screen? That's if you've got time. Just while Cliff's pulling that up. So just so you know, guys, these are the 7 growth drivers. Obviously, we've now looked at quick win cash. So hopefully the overhead saving is bringing in a little bit more money to your business. Hopefully that's helped you out. I've just got a query from Charlotte on the point of IT. Maybe look at automating the processes that are currently being done. So yeah, you can change that by utilizing your software really. So Xero is a great tool for allowing you to, rather than input the data, it will let you just scan it in and do most of the work for you.
I just think with all types of businesses, I know it's an extra cost, but I know we've done it with a few clients now. We've looked at automating those processes so that themselves, the business owners, can go out and do the more of the business development side to bring in more money. So although it's an extra cost, and you're talking about overheads, saving overheads, and reducing, it benefits because obviously you'll be able to spend more time on the business doing what you do, be that a trade, white collar in an office like we do, Catherine, and flowers like you do. It gives you the time to go out and do what you want to do and bring in more clients and customers. So that is, although it's an extra cost, like I say, it is an area that you should look at to be able to optimize the bottom line.
Right. I think following on from what David spoke about, I'd like to share with you things that I've learned, probably my second or third business, and that's the power of expenses and the true cost formula. Now, I know we're all running our companies, we're all busy, and I think we need to get the best return for our time. And I just want to show you 2 quick things that I've learned over the years. Some may be very obvious, but the true cost formula for me was a real standout reality check back in when I first started out. So if we look at the power of expenses at first, yeah, we've got 2 companies. They could be competitors, but they are exactly the same. They've got annual turnover of £1,000. That could be 10,000, 100,000, £1 million. I just kept the numbers small for this example. If you take their cost of sales, the overheads and expenses of 900,000, they create a net profit of £100. Which is 10%, which is pretty much a ballpark figure for where most companies want to be. Now, both these owners, their target for the next 12 months is to increase their profit by 30%. So the owner of company ABC brings his sales team, his marketing team in and says, look, we need to grow the company. We need to increase profits by 30%. I want you to go out and get more sales. We need to grow the business. And I've done some numbers, and we have to grow the business by 20% in order to achieve our target of a 30% increase in net profit. So off they go. They work really hard. And at the end of the 12 months, they succeed in achieving their goal of a 30% increase. On the other hand, the owner of XYZ Limited, he calls together, or she calls together the staff and goes, look, please go through the P&L, look at all our overheads, all our expenses, and see where we could find a few savings. Now, I'm certainly not one to condone cutting expenses to the point where you cannot function as a business properly. But I think we can all agree within our companies, there is some leeway, some fat that we could trim off that's a bit excessive. So that's what XYZ did. They went through the P&L and they found just over a 3% saving, and which meant that they also achieved their profit of an increase in profit of around 30%. So just by doing something very simple, finding 3%, which to be fair, if I would go back to my companies, I can probably find at least 5% worth of savings that I can really cut down on, be it utilities, be it potential fuel cards, how I spend the money. So looking for savings in the initial round is a much easier. So if you compare both companies, ABC and XYZ Limited, they both achieved their goal. However, out of the two owners, which do you think is the most stressed and has to work the hardest? And I'm sure you agree that the owner of ABC would be the more stressed and the hardest work, where XYZ simply found a few savings. Now, if we were to have the owner of XYZ Limited start to grow the company in the same rate as ABC by 20%, you'll see that he achieves the same results, but his profit more than doubles compared to the company ABC Limited. So by focusing on the expenses first, ensuring that the company is operating as efficiently and as effectively as possible, you actually get a lot more for the effort you put in. So you can see the difference here is quite staggering. And then lastly, I want to share with you the true cost formula. And this is something I came across in my company many years ago. In this case, let's assume that I need to buy a new printer, and this printer costs £300. Now, if we were to assume my net profit was 8%, which means that for every £100 that I spend, I get £8 in my bank account before tax. So in order for the company to pay for this printer, how much sales do you think this company would need to generate to break even on this printer? And it's a staggering £3,750 just to pay for this printer. Now, I don't think there's anyone from HMRC here. So what I used to do when I found out this true cost formula was I used to go to the till every lunchtime and do a £9.99 refund from the till, take £10 out, walk down the street and go to the sandwich shop, get a nice homemade sandwich with a drink. Now I did that 6 days a week, totaling £60. Now, by applying the true cost formula, and my company at the time was generating a net profit of 8%, the company would have to generate sales of around £750 per week just to pay for my lunches. And once I've realized the damage I was doing to my business, it changed the way I think about spending money. For me now, every pound I spend has to do one of two things. It has to give me a return on investment, or it has to go some way in reducing costs and making the company run more efficiently. Otherwise, it's just a waste of loads of work, loads of expenses. And in my case, in my little retail business, now our average daily takings was around £850, £950 a day. So I was almost wasting an entire day's trading to pay for my week's lunches, which is quite staggering. So I just thought I'll share those two things with you, that there are much easier ways of improving and growing your profit margins by just looking at your overheads, looking how you're spending your money, and just being a bit more proactive in what you do and how you spend it. So that's just the power of expenses and the true cost formula for you guys. Any questions on that?
Thanks for that. I think it gives a really good insight into those things we don't think about and its actual impacts. And again, visual's key. It's not all about just telling you that 8% works. It's, bringing that into a formula where everybody needs a printer these days. So that's a really good visual. Thank you. Into questions. So now that Cliff's given you some really good ideas as well, and hopefully I have too, we'll see. Has anybody got any queries, anything they'd like to run through, anything they'd like to understand a little bit better?
Thanks for that, David. And Cliff, is really good. I guess just one question from me. There's a number of different ideas there, all of which are great. Is there, from your experience of dealing with a number of different customers, is there kind of any sensible place to start? Any kind of sense of which ones would give the best return or the quickest return?
I think what you've got to do is, like obviously you may not have those visuals that we've got for you there, but you do get a set of accounts from your accountant. So if you don't use us, using somebody else, there will always be something that will stand out. So we always go to every client, and we will have, where you've got the comparative each year and the detail pin at the back. You will always see if there's a 0 one year and a spend the next year. We will always flag that up to people and say, well, look, you know, your revenue's flat. You spent more here. Why is that? Is that correct? Should that have been a personal cost tax and it went through the business, or was that something that was book kept improperly and should have been an asset purchase instead, or something else? So there's very easy information. I think to say focus on one area is quite difficult. I think you just need to first look at your accounts, what they brought out. And again, I know it's looking at the lag indicators, so it is based on information that could be 9 months old. But if that's how you currently work, we're going to find it hard unless you come and use the service and give you that more up-to-date information. So unless we can get into Xero and we can call these reports off, it's going to be hard to use current information. But Xero is really good these days in that you can run a P&L and you can do a comparative. So if you did want to find out, there is information in that software. So yeah, you can definitely, I think when I sat down with you recently, Tim, you know, I did say, go and use your Xero. You can run a P&L just so you can see how you're performing. So if you're on that, you're on QuickBooks, those options are there. I don't know how everybody else's business is set up and what software they use, but there should be something to help you out. And if ever you're like, look, here's what I've got, can you try and find something for me? Then we can do that. Just give us a call. Happy to help. And then we can see what its actual impact is on the business.
And Tim, I think you mentioned before we started this workshop that of the success in selling your business. And I think from a buyer's perspective, we always look at trends. So even as we go through these workshops and we look at various parts of the business, I would say look at the trends. Look at the trends of your expenditure. Are your telephone costs going up or down? Are your utilities going up or down? Are your stationery costs going up or down? Fuel costs going up or down? Look at the trends on every single line item and then ask yourself, is that a good thing or a bad thing? Can I improve it? And anything you can do to improve, especially on the expense side, will have a dramatic impact on your profitability. So I would just go back over your accounts, and the VFD reporting suite does allow you to see those trends very, very clearly. So I would look at trends, first of all, and see which ones are really out of kilter, which ones are going in the wrong direction, the worst, and see if you can make any changes to that. And then slowly then just do an incremental change over a course of, say, a 90-day period of reducing and trying to reverse those trends as much as possible.
That sounds great. Thank you.
Any other queries, anyone? Observations?
No.
Is it giving everyone an idea of what they can do moving forward and how simple it actually is just to go and look at your current information? I know that obviously, you know, like I said, there is information that is behind, there is 9 months ago, but it can still be used, just not as well.
I think actually probably to look at our software that we're using in the office for accountancy, because I think it's actually taking up more time than we need to be taking that could be better off elsewhere. So we probably
so even that in general, if you're using, you know, some businesses run a bit smaller and like to use things in Excel, and some people file their own company's house the old school way. You know, Xero, okay, there is a cost involved in it, but if you look at what it's actually going to bring you in saving you time, it really is worth it. And we do plug to use those softwares as much as possible. So we're not using paper anymore ourselves. So that's what we want. We want to teach people so that they can eventually save themselves money. That's the key goal. It's all there in place. We're gonna turn digital completely eventually. So why not get set up now and cut those costs?
Yeah, well, that's what I've been aiming to do anyway for the last 6 months, or probably a year. So yeah, I'd like to have a look at that and see what the cost is, time, and everything else. That'd be great. Thank you.
Yeah, sure. I'll have a word with you afterwards about that.
Thank you.
Any other queries, anyone?
I think it's also kind of having that discipline of sitting down and actually looking at your costs. I think certainly for me in retail, I'm kind of constantly kind of looking forward and planning of what's coming up next. And just while we've been on this call now, I've just been having a look at my outgoings and things. And when I took my shop on last year, I did my utilities through a broker. And I'm paying them £20 a month because, rightly or wrongly at the time, they were looking around for sort of commercial utility contracts, and was saying, I would save that amount that I'm paying them each month because they'd find me the best deal and all the rest. A bit naive, I think, back then. So I've just cancelled that. So that's £20 a month, and I'll just put some time into just reviewing my utilities contracts. I think it's, like you say, it's sort of little bits like that yes, it's still £240 a year, but that's £240 I could be spending on, advertising or stock or something else. So I think, for me, it's certainly kind of having that discipline of sort of sitting down monthly or quarterly or whatever, and actually having a good look of what's going out and where we can make some savings.
Yeah,
we see that quite a lot. Sorry, David. Yeah, we see that quite a lot with clients, that when we do sit down with them, and often it's when we're doing an annual review, but like David's already mentioned, that's too late. It's last year, and we're further down the line. So I try and educate the clients to maybe once a quarter, if they're VAT registered, if they're VAT registered, their books are going to be up to date as of that end of that quarter. So at the end of that quarter, ask your accountant to just run off a P&L for you, have a look at it, and just spend the next sort of 2 quarters looking at them and comparing. Before then, when you get to the end of the year, you're more in the know of what you're spending your money on. I mean, Cliff, your true cost formula, that's a new one on me today, and I've just put a few figures in on what I've spent over the last week, and actually it's just made me go, oh my God. So, and it's just that realization of what you're randomly spending on that you think is so necessary for the business, actually the impact on what you've got to do to bring that money in to be able to spend it and get that profit that you want to be able to reward yourself for doing the business. It's a learning curve, and it takes time, but once you get that instilled into your mindset of how you're running your business, it will just be an everyday occurrence.
I think Catherine as well. I've run a couple of retail companies, and this workshop and next week's workshop, I think will be an eye opener for you, because I've always struggled with cash flow on a retail basis, and it's because my spending was out of kilter and my cash flow wasn't under control. And by having this session and next week's session will be a real bonus, because you can really then harness your cash flow to the best of your ability. Look at your debtor days, credit days, stock days, especially because that stock on your shelf that I had in my shops was just gathering dust, and they wasn't actually producing any income for me or giving me a return. So I think you'll really enjoy next week's as well.
Thanks, Cliff. And
sounds a bit scary, but yes.
Thanks for that, Cliff. And Cliff's going to be here the whole 12-week sessions, because obviously, like I said, he's been there, he's done it. He's basically going to be a bit of support for us and give you as much advice as possible. So that'd be great for you as well, Catherine. Okay, so let's just go into some key takeaways for today. So remember, it's the little things that count. Don't forget to keep on top of your overheads. Do analyse them as much as possible, and spend your time wisely on those that you can reduce. So obviously for you, Catherine, I know you said you're spending for that broker, but a lot of brokers are actually they can actually help in that they do look for the best price each year and will bring it down each year, not allowing it. So they'll move you from somebody that cost is going up to the next one that's going down. So the person we use will do that each year. Each year he'll find us something to keep our cost the same each year rather than it going up. And that cost you're spending, I suppose, if that is keeping it down for you, then that is beneficial. But it's whether or not that is happening. So you can have a look at that and ask them.
Yeah, I'm not sure it is happening actually. So it's one to look at.
Yeah. Okay, so homework for next week. So we're going to ask you to have a look at putting together your debtor days, so your accounts receivable, creditor days, and your stock and inventory. So I take it not everybody will know how to calculate those things, but if you do want some help, I'm here. You can just give me a call, give me an email. We can run through. We can show you how that comes about, how we got to understand, what the 72 days for Alex actually was, and how it went down by 3 days. It's all based on revenue. And a percentage of 365 days a year. So it's quite simple, but it's actually giving you that formula to plug your figures in. So if you need some help, do just give me a shout after. I'll send out some slides after this meeting this week, and you can review this meeting online once I upload it. And also missed that one. So again, have a look at what it was for last year, this year, and what you want it to be for next year. Okay. And finally, so we've now done week 3. Quick win cash, or optimizing your overheads. Next week, Charlotte's going to run this for me because I'm not here, and she absolutely loves cash flows. She jumped around the office when I told her, so that's going to be her running that meeting. But yeah, that's again going to be a great week. Cliff's here as well. So any queries, just give us a shout in advance or afterwards. But it's going to be really interesting for you. And for week 4, please go to the website, book your place, and you'll get the link for next week. But yeah, this will be up online soon. So thanks everybody for watching, and thanks for your input today. And hopefully see you next week.